I was saying to Jesse, I think the Secure Act, it might have been good to just refresh everybody on what's out there, since we've all been overwhelmed with COVID and the CARES Act, and this kind of got thrown to the back burner. So I'll go over, briefly. I won't go into detail because I'd be here forever, on the few things that stand out the most that are effective for this year, and to know that it's out there. The first one being the plan startup credit increases. The old law was for a new plan that started up and had at least one non-highly compensated employee in the plan, you got a tax credit of $500, or if it was less, 50% of your startup costs. And that would be for 3 years. They've increased that now. So they've now limited it to the lesser of 50% of the startup costs, or the greater of $500, or the lesser of $250 times the number of non-highly compensated employees that are participating in the plan, or $5,000. I have an example on the next page to go over that calculation. But you're looking at up to a tax credit of $5,000 in a small plan, which is a very nice tax credit for the first 3 years of the plan, where small plans are always concerned with, looking at the fees and what it costs. Is it worth it? So the law is trying to, motivate employers to set up these plans so employees can start saving. The law also added a credit of $500 per year for 3 years if you add the automatic contribution arrangement. And that's not limited to administrative costs, and it's whenever you add it. So if you have a 401k in existence right now and you decide to add that, you're going to get a tax credit of $500 a year for the next 3 years. These all take effect starting now in 2020. On the next page, I'll go over the example.
Hey,
Hello?
Judy,
Yeah.
Judy, does that require an amendment to the plan document?
No.
None. Okay.
Oh, wait. Oh, yes. The automatic contribution arrangement. Yes, that does. Yes.
Okay. Do your documents ever include that, or is that on request only?
That's on request only.
Got it. Okay.
And the one thing that they did change is they changed the increase. Right now, you can only go up to 10%. It's gradual. You go 3% automatic deferral. You could bring that up to 15% now. I don't know how many people do that or put that into place. I haven't seen too much of that, but it's out there, and that's what they've done for this new law. And the example of the startup credit, if I'm showing here, you have 25 non-highly compensated employees, and you have a startup cost of $7,500 for a 401k profit sharing. So $250 multiplied by the 25 is $6,250. So the lesser of $6,250 or $5,000, so you have $5,000 here. It's greater than $500, but however, they're going to be limited to 50% of the startup cost, which is $3,750. Now, if your startup costs are $10,000 or more, you could take advantage of the full $5,000 credit. But you'd have to have at least 20 non-highly compensated employees. But it's still a very nice, attractive credit. And the amount that you may still deduct, but however, you can only deduct the amount that exceeds the credit that you didn't get the credit for. So you could deduct it as an ordinary and necessary business expense. So just to know that that's out there, it's in effect, it's for 2020. It's good to keep that in mind when trying to talk with your clients and setting up a new plan. And that applies for defined benefits as well, but it's a brand new plan. Oh, it says who can claim the credit. You have had not to have a plan in effect for 3 years prior to the first year of the credit. So for the credit to be available in 2020, you could not have had a plan in place on or after 2017. It's only available for plans with less than 100 employees, the same rules that apply to simple IRAs. And you must have at least one non-highly compensated employee. So owner-only plans can't take advantage of this credit. It's only for those that have at least one non-highly compensated employee in the plan. And that could be part-time, anybody. And those qualified startup costs are expenses paid or incurred for the establishment or the administration of, the plan. Also includes expenses for any retirement related education with the employees. And you also can, if you were considering or spending any money in the prior year, you can apply that to your expenses, and you paid, let's say you do it in 2020 and you did have some 2019 expenses for the 2020 startup, you can use that towards your expense, allowable expense for the tax credit. Okay, so my other stuff just went off. Okay, deadline. Oh, another new item in the Secure Act, which is very nice. They extended the deadline for adopting a new plan. Currently, if you want to take in 2019, so this is for after 2019. Currently, if you wanted to take advantage of a deduction for 2019, you've had to have a plan in place and signed by December 31st, 2019. They changed that. You now have up until the due date for filing your tax returns to adopt the plan, and that includes extensions. So if you're filing a March 15th, you have up until March 15th. If you go on extension, you have up until the extended deadline to adopt the plan, which is very nice because a lot of times you really don't know in December if it's really going to be. I can't tell you how many plans we've had where they set it up in December and then they say we can't do it for 2000. They can't do it the following year. Or in the other case where you didn't think you could do it, and then now you're doing your tax returns and you have a big tax liability, and you say, oh, I really could use a defined benefit or a profit sharing plan. So you can now set that up for when you're filing your tax returns. We just got to watch for certain deadlines. Like let's say you have an extension up until October 15th, or even, September 15th gets very close. If you're going to do a defined benefit plan, they have a minimum funding rule, and that I'm going to refer to things on a calendar year basis. Most plans are calendar years. So if you're going to set up a plan for a calendar year, usually you have to fund the plan by 8.5 months after the plan year. And so that's September 15th. That, but we can get creative with that. You could, I saw David Fry is on the call. We get creative where you could start the plan year in different tax years and still be able to make the defined benefit funding rules. So, and the other item is the 5,500 extension. So if you were to do it after July 31st, which is when we file extensions for 5,500s for a calendar year, you would have to then use the corporate extension or the individual's tax extension if they're doing a sole proprietor or K1. And this is all effective now, 2020. So, but we have like until 2021 to adopt plans for 2020. So people could take times if they're not sure, if they're on the fence about putting in a plan. The only issue is 401k. Did I put that in here? Oh yeah, I did. You have to have the document in place before the plan can accept any tax deferral, any 401k deferrals. So you would have to have that in place currently in this year to take advantage of 401k contributions. Even if you're a sole proprietor or you're filing a K1 partnership, you would need to have that in place by December 31st, even though you don't have to make the contribution till you file your tax returns, including extensions. The law says you need to have this in place for 401ks.
Does that also apply to employee deferrals now, or is that employee deferrals still have to be made by December 31st?
The employer deferrals that have to be in by December 31st are for all those that are being paid by a W-2.
Okay.
So that would be your C corporations, your sub S corporations. If you have sole proprietors that are filing a Schedule C, or if you have a partnership where they're getting K-1 earned income, they have up until they file their actual returns to make the 401k contribution.
Okay.
Okay. Safe harbor notices is another one that they've added a provision that you do not now have to provide an annual safe harbor notice for a 401k safe harbor 3% non-elective contribution. But if you have the safe harbor match, everything else still stays in place. You have to give a notice. That's because in a match situation, you know, the employee needs to know if they're going to get a match, then they would defer. They can make a decision to defer or not. The 3% non-elective, they're going to get that anyway, whether they defer or not. So now the IRS has eliminated the need to put in a safe harbor notice 30 days before the plan year begins. And even during the year, if you decide you want to add a 401k 3% safe harbor, there's no notice requirement. And there's also a late adoption of that safe harbor non-elective. So if you start the plan with the regular 401k ADP tested, and you find out that you want to maximize the owners, but it's too late to put currently it would be too late. So if you're in 2019 and you realize before the end of the year, we're going to fail the test, my owners are going to, you know, have to either take a distribution or they're going to have to make a QNET contribution. It's usually messy. You would have had to wait until 2020 to have a safe harbor because you already have a 401k in place. Now you can, 30 days before the plan you're in, add the safe harbor non-elective provision and still keep it at 3% and then pass your test and maximize your owners. Or if you don't do it that 30 days before, you have 12 months until the following year, but it has to be 4%. So that's, they gave a little relief on that, which makes sense. So.
Hey, Judy,
Yeah.
Was there any extension on the contribution deadlines for SEP IRAs and simple IRAs? Are you aware of any there?
No, I'm not. Not for Secure Act, I'm not.
Okay.
I think only some of the CARE Act might have been, but I'm not familiar with that right now.
Okay.
I'll
Okay.
look into that.
Okay.
Okay. But, okay. They've added another provision, which is now called the long-term part-time employee, LTPT. They are now requiring, if you have, this doesn't take effect till plan years beginning after 2021. You now have to count employees, long-term part-time employees that had 3 consecutive eligibility computation periods with at least 500 hours of service. However, you don't have to count it for plan years prior to January 1st. You don't have to count the service prior to January 1st, 2021. So the service starts counting January 1st, 2021. And you can impose a minimum age of 21 and a standard entry date. So the earliest entry you're going to see in this law right now won't be until January 1st, 2024. So you must allow them to come in and defer to the 401k, but you do not, we can exclude all of them from safe harbor, other employer contributions, top heavy, cash balance, defined benefit coverage, ADP, ACP tests, and 401k non-discrimination testing, all non-discrimination testing. So the only thing we would have to watch on that, you know, depending if you're a certain kind of company that really has a lot of long-term part-time employees, if you go over the 100 employee mark where your 5,500 is now going to require an audit. But we have a while to worry about that. So God knows what's going to happen in 2024. But just to know that that's what's out there in the Secure Act. So let's see. The next one, this is another one where it's taking effect now for 2020. They added a new distributable event for defined contribution plans. And that's if you have a qualified birth or adoption, you are now allowed to have a $5,000 distribution up to 1 year after the birth or the finalized adoption. That's an individual limit, so they could take a $5,000 distribution. No early premature distribution penalty will be applied. And if they have twins, it's $10,000. And they can pay it back just almost like the COVID distribution. The COVID has to pay it in 3 years if you want to not pay taxes eventually on it. Here, they have not put a limit on it yet. So it's almost like, so far as it reads, you have up until as long as you're in the plan to put it back. You can pay it back. You must pay it back either to the distributing plan or you can pay it back to an IRA. It is taxable in the year you get it. You're just not going to pay a penalty. And if you decide to pay it back, you will get a tax credit for whatever amount you pay back and in whatever year you pay it back in. So, and it's an individual limit. So if a couple each are in a plan, they each can do the 5,000, or if they have twins, they each could do 10 up to 20. Just so to know that's out there, people who need the money available to them. And next is the increase in the retirement minimum required distributions for the required minimum distributions for those over 70 and a half. I'm sure most of you already know this. There's been so much discussion on it. Has been increased to age 72 for those 70 and a half, those that turned 70 and a half in 2019. So those are for all those born after June 30th, 1949. They do not have to start taking their minimum required distribution until their 72nd birthday. No more half, it's 72nd. And we all know, I'm sure that the CARE Acts, they eliminated the RMDs for 2020. Any questions on that one? I guess not. The one thing I did.
I do have a quick question, Judy.
Sure.
You know, in the specifics of the CARE Acts, they eliminate RMDs for 2020. Right. Is there any requirement for that ever to be paid back? Just, you know, as if, or when I say paid back, for them to make up those RMDs, or is it's a freebie? So it's a gimme for. Yeah. Okay.
They got a freebie, and if they had already taken it, they were allowed to put it back in. I think the deadline's the end of this month, August 31st.
Right. Okay.
On that. The one thing I forgot to add to this is the stretch, the elimination of the stretch IRAs, beneficiary payouts they added to the new law. They basically, you know, the new law now lets you to choose non-spouse designated beneficiaries to distribute the money over their life expectancy. They've now limited it to 10 years to most death beneficiaries. The ones that, there's exceptions though to that. The beneficiary at the time of the participant's death must be either the spouse, a disabled or chronically ill individual, a beneficiary that's not more than 10 years younger, or a child who has not reached the age of majority. 10-year time frame starts when they reach the age of majority. The age of majority, I think, is still up in question as to what that age is, 21, so forth, but then they would be limited to 10 years. Okay. Oh, so the next one is portability of lifetime income options. This would be more applicable with your financial advisors, but plans now have pretty much should offer you the portability so that you can roll out the money to another rollover vehicle where there won't be a distributable event. It would be limited to a direct rollover. When you have one of these annuity investments and the plan is going to drop this investments, this is so you don't have to incur, you know, the early penalty charges. So they have added that in there to protect the participants from those charges and have that availability to them. But the plan has to allow that, you know, to happen.
Yeah, I have something to add to that, Judy, because this was confusing to me as someone who runs a retirement plan program when this legislation first came out. My question was, the way the language originally read, it sounded like they were forcing plans to offer lifetime income options, but that's actually not the case. So plans, it's not that plans have to offer those lifetime income options. It's just that if they do offer them, they have to allow them to be portable out of the plan. So that's the point, just a clarification point that I came across when this first came up. I thought it'd be useful to everyone else still. Yeah.
Yes, very good. And that like on my next slide, which what did come out that's mandatory is the disclosure of showing what the lifetime income would be in defined contribution plans. You already have that in defined benefits. They now want defined contribution plans to show a lifetime income stream equivalent to the account balance, like expressed as a monthly benefit, a single life annuity, and there won't be any fiduciary liability if you go according to the DOL assumptions and explanations. I have attached, because they just came out with this on August 18th, the other day, their interim final rule with their explanations and assumptions. This is mostly going to apply to record keepers and TPAs like ourselves to make sure that, you know, we're going to have this in place, but it's going to be required on the employee benefit statements. I'm not sure of what the deadline is just yet, but they will come out with that and sure let us know. So I did attach the fact sheet that just came out. There's a couple of pages there if you're interested in looking at that.
I'd be surprised if this doesn't cause some confusion among plan participants once these statements start coming out, because people I think a lot of people are going to assume when they get these that it means that they have a guaranteed payment amount.
Yes.
It's, as if it's a pension, defined benefit pension plan, when in fact that's not the case because it's defined contribution. So that's going to need some clarification, I think, some hand holding for some people, so that they understand this and don't think they're getting they have an extension.
Right. So if you use, you will be relieved from that fiduciary, because that's exactly right. That is a big concern. And if you follow their model, their assumptions and explanations, then you're going to be relieved of that liability should somebody, do exactly what you said. Expect a certain amount that's being disclosed that really is just a projection, an estimate.
Right.
So it's another piece. And then they increase penalties for late filings. I added a chart from another outline on the new penalties. They went up pretty substantial. I mean, you look at your form 5500, went from $25 a day to $15,000 max, from $250 a day to $150,000 maximum. That's pretty substantial. You will still have available that VCP program. So if you do find yourself where you haven't filed the 5500s and they are late, you can file with the VCP program, voluntary compliance. It's $750 for each plan up to a maximum of each plan year up to a maximum of $1,500. So it'd be well worth it to file it right away as soon as you find out you're late. Even if you wind up getting an IRS letter, you are still eligible to file with the VCP program. But once you get the DOL letter, it's done. Then you're going to have to hire an attorney, or it's going to, then you're not eligible for the VCP program. So as soon as you find out or realize that it's worth the $750 or the $1,500 to file the late forms, and even if you get the IRS letter, they will actually put that in their letters to let you know that you are eligible to do that when they send you the letter that the form is missing, so, or late. And then the other ones, the withholding one also went up pretty substantial. And then I think this is the last one I showed. Okay, the last one is as far as the Secure Act, which are the MEPs, PEPs, and GOP groups of plans for annual 5,500 filings. They've actually added what you call pooled employer plans, which are similar to the open multiple employer plans. Right now, multiple employer plans are a group of plans where there's not a control group, there's not common ownership, and they're all in one pooled plan. But they had the, you had to have, right now in the MEPs, usually there's some commonality as to why you're in the MEP. And if there's what they call the bad apple rule, if one employer didn't fail to do something, the whole plan was affected by that. They call it the bad apple rule. They've eliminated that. And now they've called PEPs, pooled employer plans, which are now what was the open multiple employer plans, where there isn't a commonality. You could just have like someone like a TPA or a record keeper, financial institution set up a pooled employer plan, but everything, they would have the same trustee, they would have all of the same record keeping assets, so forth, but you don't have to have that commonality of being in the same industry or so forth. I don't know how popular these are going to be, because the people who are going to sponsor these PEPs are going to have a lot of responsibilities, a lot of fiduciary responsibility. So I know there's been a lot of talks on it. A lot of people in the industry are not sure really how this is going to go forward. And I actually attached an article from Asper going over some of that, being that, what their thought was on it, what's all the fuss about, etc., and the differences. So it's a nice little article. I know there's been plenty of them out there, so I'm sure you've heard plenty.
Hey, Judy, on these PEPs, is there a limit to how many, employers can be part of the plan, or size of the, assets per employer to be added to the plan? Any kind of limitations in that area? Not
that I'm aware of. But you want the more the better, because of the cost, to keep the cost down. Like the whole idea, I think, between the PEP is to keep the cost down for the small employer.
Right.
But if you don't get the assets, it's going to cost them anyway. They're going to need to try to increase all the assets so that the asset charges are going to keep the asset charges lower.
Right.
Some people are not quite sure, how they're going to keep them at a reasonable size. You're going to have to also provide, if you are a PEP provider, as they call it, I think a PPP, you're going to have to offer 316 services and hire somebody for 338. So you're going to have to provide all those services as well.
Okay. So for example, 4Thought, we are a 338 investment manager. We don't do 316 or 321. We're 338, right?
Okay.
So does that mean if we started our own PEP, we would also need to offer 316 and 321, or yes. Is it
360? Yes, 360.
Yeah.
Yes,
okay.
You would have to do it, and you would be required to make sure everybody's making their contributions, that all the employees of all of the employers. So I'm not we don't handle them.
Right.
We're going to be thinking of doing it. I mean, they are opening them up to TPAs to do as well, but I'm not sure I know of many that are. but it might
Right.
be, in your situation, might not be a bad idea to look into it.
Yeah, it's something I've been considering, researching. So we'll probably at least do that and see
Yeah.
how it goes.
Well,
Yeah.
and we could always work with you with that as well, if you
Right.
want to, yeah, set something up like that. I think some people still aren't sure. That's effective. I think that takes effective after in 2021. It's right, in 2021. So you
Okay.
still have time to look at that. And I have plenty of articles on that. Oh, I keep forgetting that you guys are watching my outline. I also added the maximum contributions. I updated it from last year. So this is the current year, and that's it. Does anybody have any questions?